Welcome to Her Money Revolution. I'm your host, Angela Brooks, your guide on this journey to becoming a wealthy woman. As a certified financial planner, business owner, and wealth advisor, I am on a mission to simplify the conversation around investing and to help women generate more wealth by making their money work for them. Join me as we navigate powerful financial planning strategies to help you achieve your personal and professional goals. This podcast is your go-to destination for no fluff, easy to implement financial and investing advice. If you are ready to achieve audacious financial goals, dream beyond boundaries, and generate massive wealth for you and your family, this podcast is for you. Grab a notebook, let's get started. Hello, welcome back to Her Money Revolution. In the last episode, we discussed the importance of assessing your current financial situation. If you missed it, go back, take a listen. I went over tracking income, expenses, debts, assets. I provided tips for creating your value spending plan, which you could download at hermoneyrevolution.com. I talked about the importance of setting financial goals. I really hope that you have spent some time working through everything and have a solid foundation and feel really confident going into today, because what we're going to talk about today is investing. And I know investing can feel very overwhelming, especially if you are new to the game. That's okay. Fear not, because today I'm going to break down the basics and show you why investing is truly essential for securing your financial future. Now, before I kind of dive into some stuff, I want to talk about some misconceptions. So many people think that investing is something that only rich can afford to do, that you have to have a lot of money to start. But that is the furthest from the truth. I promise. Investing is not reserved for the wealthy. That is a misconception. These misconceptions often stem from a lack of understanding. But once you truly take the time and you educate yourself, you will recognize that investing is a journey. It's about making informed decisions. It's about staying committed to the process and your goals and continuously learning along the way. The investment world is always changing. And if you're not growing and learning with it, you're going to feel not knowledgeable enough and not want to do it. But don't let these myths hold you back from investing. All right, let's ask the big question. What is investing? Okay, well, I'm talking about the stock market. I'm talking about investing into the stock market. So at its core, it is putting your money to work for you with the goal of earning a return on that investment. So instead of letting your money sit idle in a savings account somewhere, although money markets are paying decent rates right now, they're not growing as quickly as they could be if you're investing into the stock market. And this is what's essential for you to grow and build wealth over time. Compound interest. I'm going to talk about compound interest because it is a powerful tool. It is essential for building wealth. You want to understand compound interest, leverage it. You will significantly enhance your financial future. So what is compound interest? Well, okay, so essentially it's earning interest on interest. You have your principal that earns money. So it's that interest, it's earning interest on top of interest and accelerates it over time. The real magic of compound interest lies in its exponential growth. The longer you leave your money to compound, the greater the effect. Let me explain this a little bit more. So here's why it is so powerful. Compound interest is time. The more time your money has to grow, the more you benefit from compound interest. So start early. That is key. Start early. My kids, they're not even in elementary school, one of them. They're investing. That's early. Frequency. The more frequently you invest, your interest is compounded. The more your money is going to grow. So daily compounding, for example, yields more than annual compounding. I'll give you an example here in a minute, but the other key thing here is reinvestment. So you want to continuously reinvest your earnings that allows that interest to compound on an ever increasing principal. Principal meaning what you are putting into it. So if you keep reinvesting the interest, you're investing more principal. Let me give you an example. I have my handy dandy financial calculator. So let's call her Emily. So if Emily were to start investing $200 per month at the age of 25, let's say, into an investment account. This investment account is going to earn an annual interest rate of about 6%, okay? And we're going to compound this monthly. That's the frequency. So using my calculator, I'm going to go ahead and calculate the monthly investment of $200 with an annual interest rate of 6%, compounding monthly over 40 years. So until she's 65. So by the time Emily is 65 years old, what her contribution is going to be is $96,000. Okay. So that's that $200 a month. So 200 times 12 times we said 40 years. Her contribution is $96,000. However, when we talk about compound interest, her investment account growing at 6% is going to grow to approximately $398,274. Guys, it's huge. That's how you grow wealth. It's compound interest. You want to invest into things that are going to grow. I just use a 6% as an example, but you want to do something more than letting it sit idle in a bank account earning nothing. So the key takeaways you can write down from the benefits or the magic in compound interest is to start early. Earlier you start investing, the more time your money has to grow. You want to make regular contributions. So you want to consistently add to your principal. That's going to accelerate that growth. So set up those systematic. And if it's not $200 a month, you can make it $20 a month. Just start with something. And if you work with a financial advisor, they should be able to help you set that up and make, if you can increase it every year, increase it as much as you can. That is key as well. And then you want to reinvest the earnings. So when you reinvest any earnings to maximize the effects of compounding, you don't want to take the earnings out, let it continue to grow, it builds the principal. And then patience. Anything that I talk about, this is not get rich quick plan, but it's going to take time. I'm not telling you go to the casino, win a bunch of money. I promise, trust me, I've seen it. You'll lose a bunch of money as well. But patience is essential for compound interest to work. Okay. It's going to work the best when you have the longer periods of time. So you want to be patient and let your investment grow. So again, start early, contribute on a regular basis, and let time work its magic. Now that we have talked about compound interest, you understand at a high level what investing is. Let's dive into some of the investment concepts. And I'm just going to really stay high level with this. I don't know if you're driving or what you're doing, if you can take some notes, but I want to just give you the basics just to start this conversation so you can understand what we're even talking about. I would really, really love if you send me some follow-up, some feedback. Let me know what questions that you may have or where you want me to spend more time. I want to make it relevant and consistent. But anyway, let's talk about stocks. Okay, so when you buy a stock, you are purchasing a small ownership stake in a company. Stocks offer potential for higher returns, but they also come with greater risk. Okay, there's different types of stocks. Common stock, which is the most common or the most prevalent type, is common stock. There's also preferred stock that you can have. Stocks are bought and sold on the stock exchange, like the New York Stock Exchange or NASDAQ. Okay. How are they priced? Okay. So, and I have notes because that could just go off from anywhere. So I'm trying to make sure I cover everything. But market price, the price of a stock is determined by supply and demand in the market. So the benefits of owning a stock, of course, capital appreciation, ownership and influence. If you're a common shareholder, you have the right to vote on significant company decisions. You may or may not want to partake in that, but it's an option. Next, I want to talk about, there's so much more I can dive in with stocks, but let's move on to bonds. Unlike stocks, bonds are a form of debt. When you buy a bond, you are essentially lending money to a government or a corporation in exchange for regular interest payments and the return of your principal investment at maturity. Okay, so when you buy a bond, it earns interest, you get your principal plus that interest back in return. Bonds are generally considered less risky than stocks, and they typically offer lower investment returns. So there's different types of bonds as well. There's government bonds that are issued by national governments. Those are considered low risk. especially if they're by like stable governments. Let me give you an example of treasury bonds, treasury notes, treasury bills in the US. There's also municipal bonds. This is issued by states, cities, or local governments, and they often offer tax-exempt returns, meaning you don't have to pay interest on what was earned, it's not subject to federal and sometimes state, local tax. Then there's corporate bonds, agency bonds, and I don't want to not going to dive too much into all of those, but the benefits of owning a bond is that regular income, it is capital preservation, diversification. Even if you're a young investor, I highly encourage you to have some portion of your investments in bonds for just that diversification. Another benefit of owning a bond is the interest rate risk, inflation risk. So like right now, I'm going to be careful what I say, but right now we're anticipating it's a volatile market. So if you're a young investor and still having some of your portfolio in bonds so you can take advantage of the downside. So when the market drops, then you can take your bond portion and rebalance that into a more growth-oriented stock position. Okay. Anything more on bonds? I'm going to move forward to stay high level here. Mutual funds and ETFs. ETFs, also known as exchange-traded funds. These are investment vehicles that allow you to invest in a diversified portfolio of stocks or bonds with just one purchase. So it's basically a basket of stocks and bonds with one ticker symbol. The difference between a mutual fund and an ETF, mutual funds are actively managed by professional fund managers. ETFs are not. They typically track a specific index, like the S&P 500 or the NASDAQ. Mutual funds typically have higher expenses because there is a person, a human, managing those, deciding when to buy, when to sell, whereas ETFs have algorithms built into them. There's most of the time the fees are less with an ETF. Okay. But either of those investments, they spread your investments and your risk across multiple assets, which then does reduce your risk overall. Index funds. Okay. So let's look at these a little bit more. I do like index funds. I hear often like index and chill, let it do what it's supposed to do. It is a simple and cost-effective way truly to build wealth. So what exactly are index funds? They are a type of mutual fund or exchange-traded fund, an ETF, that tracks a specific market, again, like S&P 500 or the Dow Jones. But instead of trying to beat the market by picking individual stocks, index funds aim to replicate the performance of the index that they track. It's a passive way of investing, and it typically results, again, in lower fees compared to the actively managed funds, making index funds an attractive option for many investors. So who should invest in an index fund? You, me, everyone. If you're new to investing, you probably feel overwhelmed by now and by all the options that are out there. Index funds and ETFs are a great place to start. They are a great place to start. Now let's talk about risk tolerance. So understanding your risk tolerance and your time horizon. Risk tolerance refers to your willingness and ability to endure fluctuations in the value of your investments. So normally, the younger that you are, the longer your time horizon, the more risk you can afford to take. It's just a rule of thumb, as you have more time to ride out the market downturns, okay? As you get closer to your financial goals, like retirement, or if you want to buy a second home, you may want to gradually shift to more conservative investments to protect your wealth. So bear in mind, let's talk about this a little bit more, your risk tolerance and time horizon. You want to understand if you feel like you are, let's just say 65, and you're about to start taking out of your investment accounts, but yet you feel like your risk tolerance is high, like you're more of an aggressive investor, regardless of how comfortable you are, because your time horizon is shorter from when you're going to be needing to use those funds, it's not advisable to want to invest more aggressively, even though you think that you could, because you're pulling from that portfolio. You want to make sure that you have a strategic fixed income strategy that or investment that you're pulling from. And I talk oftentimes in buckets, right? So like, this is what I'm taking my fixed income sleeve from. And then if I don't ever need to use these funds, then that's where you can be more aggressive if you feel like your risk tolerance is high. But working with an advisor really on some of this stuff, if you don't have a financial advisor, I really encourage you to work with one. I really want to simplify this conversation and teach you about investing. And we're going to do that. But if you are feeling overwhelmed, contact an advisor, find someone to work with to help you understand this as well. Okay, so why is investing so important for building wealth? Well, simply put, investing allows your money to work for you. Harnessing the power of compound interest that I talked about before to grow your wealth over time is essential. When I say have your money work for you, so you go to a job, let's say 9 to 5, Monday through Friday, to earn an income. So when I say let your money work for you, it's like going to your job. You work Monday through Friday, 9 to 5, earning an income. Well, what you can do with that money is invest it so that money continues to earn and work for you. It will help you achieve your financial goals faster. That's it today. I know I covered a lot. We talked about stocks, bonds, mutual funds, ETFs, time horizon, compound interest. The takeaway, I know I covered a lot today. We went over investing. What is a stock, bond, ETF, mutual fund, index fund, compound interest? The homework that I have for you today is go on to Yahoo Finance. Just look at some of that stuff. Maybe it's overwhelming, but as you read some of that and you hear me explaining it, it's going to start to click. It's going to start to register what these terms mean and how they can help you achieve your goals quicker. That's all I have for today's episode of Her Money Revolution. I hope that you are feeling more confident about diving into the world of investing. I know it's big and it's scary, but remember, building wealth is a journey, and investing is one that is the most powerful tools in your financial toolkit. Stay with me. We will learn and grow together. If you enjoyed today's episode, be sure to subscribe to Her Money Revolution wherever you get your podcasts. And don't forget to follow on social media for more tips and inspiration on taking control of your financial future. Until next time, stay empowered and keep investing in yourself. Thank you for joining me today, and I hope you are feeling more empowered in your financial journey. Remember, follow and subscribe to Her Money Revolution on your favorite podcast platform, and share your feedback by leaving a review. I'd love to hear your biggest takeaway from today's episode. Until next time, stay inspired.